for investing in foreign real estate if you're an American. The problem is when you invest in the foreign version of an LLC, the treatment is the opposite. It's a foreign corporation for US tax purposes, so nothing flows through. Make sure that you do it right on the front end so that you don't deal with unnecessary hassles or paying more tax than you need to on the back end. Perfect world scenario with a rental property, really. Today, I want to talk to you about a recent client situation that I had. Obviously, I'll change the facts up a little bit for privacy, but really just to give you some information on opportunities for investing in foreign real estate if you're an American, and also some things to look out for to make sure that you do it right on the front end so that you don't deal with unnecessary hassles or paying more tax than you need to on the back end. If you're new to my channel, my name is Alex McGowan. I'm the owner of McGowan Tax LLC, where we help individuals and small businesses with international tax advisory and compliance work. So in this scenario, we have an American citizen living in the US that invested in Costa Rican real estate. He ended up having 3 or 4 rental properties in Costa Rica. One was a land development. The other 2 were rental properties. For each company, he set up the Costa Rican version of an LLC. It's called the SRL down there, but basically it provides limited liability to the owners, which makes sense in a lot of cases. Even if Costa Rica, or really any country in the world, is maybe not as litigious as the United States, it's good to have that liability protection. And also, more practically, if you're living in the US and you have the SRL or the company set up down there, it makes it much easier to give power of attorney, to have lawyers sign documents on your behalf, as opposed to having to be down there to sign things and close things. So that's a lot of the reason we set these up. Where people get in trouble is that they're used to US investments. So if you set up a US LLC and own a rental property through it, the default treatment of that for tax purposes is a flow through. That means the income and expenses of that rental property are going to flow through to your personal return. If you have a loss from it, you give it on your personal return. Now, it may be a passive activity so that you can't actually use that loss until you have income from the rental or when you sell the property, but you don't lose it. It just maybe gets stuck for a little while until you can use it later. Deferred. So that's the general treatment of an LLC in the US. The problem is when you invest in the foreign version of an LLC, the treatment is the opposite. It's a foreign corporation for US tax purposes, so nothing flows through. The actual rule for that is when you invest in or own a foreign company, its default treatment is determined by the liability protection it affords. If you have a limited liability company, all the owners are afforded limited liability protection. If everyone has limited liability, it defaults to a foreign corporation. That's the rule. These SRLs in this case were foreign corporations, and this person had been operating them and picking up the losses on their personal return. And now they wanted to sell the property, or actually in this case, they had already sold it in 2024. And so of course they're expecting to get capital gain treatment, which has a maximum rate of 20%. Most people fall in that 15% bracket, depending on how much money you make, as opposed to ordinary income, which can be as high as 37%. So you're looking at a potential 17% difference on your net gain of the property, which can be huge. So if it is in a foreign corporation, you're most likely going to get stuck with ordinary income tax treatment on the sale of that rental property, as opposed to capital gain if it were a flow through. Now there's nuances to that. You have depreciation recapture. In this person's case, it was a 17% difference in the gain if he had checked the box and made a flow-through election or not. Here's what we ended up doing. You can make a retroactive. So obviously, just to step back, in a perfect world, if I would have set this up on day one, I would have made an election to treat those foreign entities as flow-throughs to match that U.S. intended treatment of a flow-through. In that case, the rental property income would flow up, losses would be preserved. They sell the property, the losses could be used against the gain, and you get capital gain treatment with the exception of the depreciation recapture. Perfect world scenario with a rental property, really. I mean, there's some other things you can do like exchanges, or if you have a real estate professional, we can save taxes that way. But in general, the flow through is step one. So that's what I would have done, but we didn't. So we're 4 years later. So what did we end up doing? Well, there is a safe harbor where you can make a retroactive check the box election to treat as a flow through, as long as either the tax return for that year the due date hasn't passed yet, or the due date has passed and you filed the tax return consistent with that intended treatment. Now, if you make the flow-through election, you have to file a Form 8858 for that foreign disregarded entity. When you make that election, if it's single member owned, it's going to be a Form 8858 and it turns into what they call a disregarded entity. Same treatment as a single member LLC in the US, but this is a foreign disregarded entity. So you have to file that 8858. If it's two people that own the entity, it's a foreign partnership and it's the Form 8865. So in this situation, the individual owned it by himself. So he should have filed the 8858. If they didn't file the 8858, you cannot go back and make the election. So you're stuck with that ordinary income treatment. But in his case, the tax preparer the original one had actually filed the Forms 8858. So he knew enough, or she, I can't remember, but they knew enough to file the 8858 for a foreign disregarded entity, but they didn't know that they had to elect that treatment in the first place. A very lucky situation for this guy. We were able to go back, make that election from day one, and he saved 17% on a big number of sales. It was also very lucky because it's pretty rare if whoever's you're doing your taxes, if they knew to file the Form 8858, then most likely they knew they should have made the election in the first place to treat it that way. So it's rare you're going to see that. Most time, people just assume it flows through like a U.S. company. They don't file the 8858. So then you get stuck. It's possible to go backwards. It can get tricky, but there's things we can do to minimize the impact and optimize your taxes based on how you expected to be taxed in the first place. So as always, before you get into any big investment transactions, make sure you're getting good tax advice. If you find yourself stuck in a situation and need help, reach out to someone that has international experience. You can reach out to me and I'm happy to book an initial introductory call to talk through your situation. Thanks for watching, and I look forward to seeing you on another episode.